Hello, everybody. We're going to give everybody a couple of minutes to sign in, and then we will get started here in just a second. Okay, everybody, I think we'll go ahead and get started. Seems like we've got quite a few people signed in, and anybody else can join us as we go along. My name is Sutton Mora Hayes, and I am the COO of the Community Foundation, and I want to welcome you to our investment Q&A session. We know this is a pretty big topic right now, and we are happy to share our perspectives with you, our donors. Before we get started, I want to do some quick housekeeping as the moderator of the call. Unlike a regular Zoom call, which I'm sure many of us have done many Zoom calls in the last 10 weeks, this is a webinar format, so you will only be able to see the panelists and the presentation, not each other. That means that I also cannot see you. So if you have a question, please click on the chat button to submit a question. It should pop open a new box and you'll be able to submit your question there. If you're on a PC or desktop computer of some sort, the chat button should be at the bottom of your screen. If you're on your phone, you may have to click on the three dots at the bottom right-hand side that say More, and then select the chat function. You can either type the question for the whole group to see, or you can send it to me privately. We will try to get through all of the questions today in the hour that we have time allotted. So with the housekeeping done, I want to introduce our panelists. Panelists, if you will please wave to the camera when I introduce you. The first is Bob Fakler, who most of you should know is the president of the Community Foundation. The second is Alex Holtel, who most of you probably do not know, but was named about 12 weeks ago as our brand new Chief Financial Officer. So we are just happy that he's here and hasn't moved back to Cincinnati. Next, we have Jay Healy, who during the day is the president and founder of Century Wealth Management, and by late afternoon is the chair of our investment committee. And finally, we have Matt Robbins and Bart Reed, who are representing the Community Foundation's investment consultant, Gerber Taylor. Each of them are going to speak briefly, and then we will open it up for questions. So with that, I will turn it over to Bob Fakler to get us started.
Well, good afternoon, and thank you all for joining us. For the past several years, we've had these investment briefings. just as a way to keep our donors and our nonprofit partners aware of what's going on with their investments. Because of what's going on in the world and what's going on in the markets, this one's obviously going to be a little bit different. So we're going to use a little bit different format. I'll review the 9 investment options that we offer and briefly cover their performance. But I really want you to, we want to spend a little time talking about how those investment decisions are made. So I'll talk a little bit about our investment committee. And then importantly, I really want Jay Healy, the chair of our investment committee, to say a couple words about kind of what's on the committee's mind right now, because we have been tinkering with a couple of the larger investment pools for the last several months. And then the COVID-19 crisis came on top of that. So their plate is certainly full. And I just wanted to have you hear from them directly, kind of what they're thinking. And then I wanted our investment consultants, Gerber Taylor, Matt, and Bart, to give you a little deeper dive into what to do right now. I recorded a video a couple weeks ago, kind of in the middle of this, just saying, you know, we're basically long-term investors. We view this as a long-term thing, so it's something that we have to endure, but eventually we'll come out the backside. So hopefully Matt and Bart will give you a little perspective into what they're seeing with those numbers. Just taking half a step back, this time last year, we were celebrating our 50th anniversary, and I just wanted to report to you, since this is one of the few times I get to talk to our donors and our nonprofit partners, that we continue to grow and change. I hope you've seen that we're managing the Mid-South COVID-19 Regional Response Fund in partnership with city and county government, United Way of the Mid-South, and Momentum Nonprofit Partners. To date, we've raised $3.2 million to respond to the crisis, and you might keep your ears open for some major announcements in the next couple days that we'll be able to talk about. Meanwhile, we closed out our fiscal year end on April 30th. We have a kind of a strange year end. So we finished the year with assets of approximately $710 million, which is a new record despite the depressed stock market. And our donors made grants of $163 million, solidifying our place as one of the largest grant makers in the South, and I believe one of the top 10 community foundations in the country. So all that's great, but from day one, the investment of our donors' funds and the investment of our nonprofit partners' funds has been a primary concern. So our mission is to protect and to grow those funds and to maintain and to increase charitable giving in our community. So, you know, we spend quite a lot of time during the year thinking about our investments and our investment strategies, consulting with our advisors, and reviewing what's going on in the world. So we've been very sensitive to what our donors and our nonprofit partners are saying. In September of 2018, we launched a new balanced index pool in answer to the calls for a lower cost passive option from our donors and partners. And then at this meeting last year, we heard that even that wasn't enough. Many of you wanted equity-only passive options as well. So last September, we launched both a US only and an international equity indexed investment pool. And then at the same time, we also launched a new index fixed income pool as well. So quickly, I'd like to run through what the investment options are. And remember that our donors and our nonprofit partners are free to choose from anywhere in this menu, however you want. You can mix and match to fit your needs. And then most importantly, you can change your investment selections as your needs change. So let's just walk through these fairly quickly. And all this information, by the way, is available on our website. And I'm going to run through our investment performance, and all of that is available, updated quarterly on our website as well. So we're going to start with sort of the safest and generally lowest yielding, and move down through the other options that are a little bit more volatile. Of course, at the top is our cash equivalent pool. It is invested in basically high-grade, short-term U.S. government bonds, government agencies, and corporate bonds. It is very low risk, but as you'll see in a second, it is also, with interest rates as low as they are, relatively low return. We have two fixed income options. So the fixed income, the fixed income options are basically investments in all bonds in the bond market. For a number of years, we've had the actively managed fixed income pool. But as I mentioned last fall, we also introduced an index pool. So the index pool, like the active pool, is invested in bonds but it is intended to just return whatever the bond market's doing, whatever the index is doing, and it's a slightly lower cost. We have two significant balanced pools, and the balanced active pool is by far our largest investment pool. It is highly diversified, actively managed combination of equity, fixed income, and a variety of other assets. I'll tell you that with what the investment committee has done, this investment mix that's showing right here is slightly different. We've tinkered with the hedged equity position and the alternative investment position, which we'll talk about in a minute. But those are all actively managed positions. There's, I think, about 24, 25 managers in there. On the other option, however, for balanced is a balanced index pool, which very simply is a combination of three index funds, two equity index funds, one that just mimics the US equity market, the other that mimics the international equity market, and a 40% chunk of just fixed income indexed money as well. And then finally, we have a number of equity, all equity options, all stock options. There's the equity active pool, which we have managed for a long time. Again, highly diversified, actively managed mix of U.S. international equities. And we've had for some time, because Memphis is Memphis, and a lot of folks in Memphis love the long leap options. We have for a number of years offered a long leap option. That's a pooled investment in three long leaf funds. And then at the last two there are the two index funds that we launched last fall, a US only index pool and an international equity index pool. So let's look real quick at how these pools have been performing. So I'm just going to go through this relatively quickly, and certainly can stop anywhere along the way at the end talk about any questions you might have. Again, cash equivalent pool measured against a 91-day T-bill index has been doing very, very well historically, but as you can see, very, very low returns. For the first quarter of this year, just 0.4%. The fixed income active pool has been struggling against its index, primarily because the primary way to get hurt in the bond market is by rising interest rates, and the way to mitigate that is to shorten up maturities. So we have a big component in the active fixed income pool is a short-term piece, which is mitigating risk for rising interest rates. Going into through 2019, that was felt that it was going to be a significant risk as the economy was getting better. With the COVID-19 crisis, I don't quite see that quite as immediately as we did coming out of 2019. The fixed income index pool, brand new, so we don't have a lot of data on it, but the early returns it does exactly what it's supposed to do. It's directly mimicking the Barclays Aggregate Bond Index, so 3.2 versus 3.1 in the quarter, and it is, since inception, it's done very well as well. On the balance side, a lot of you, again, this is our largest pool, and this is where we have been struggling and tinkering with these numbers and with the mix of it. The early returns, obviously, with the stock market down strong in the first quarter, the first quarter returns were down 13.6, which actually down a little bit more even than the index. And you can see we've struggled over the last couple of years, really the last 10 years, to keep up as we were building a defensive portfolio in a market that was still going strong. But you can see, if you go back to inception for the entire history of the pool, it's done pretty well. And then finally, again, just fairly short returns on the balanced index pool. It's having a little trouble tracking along, but the first quarter was down 12.5%, which is a little bit more than the index. But that will probably be mitigated over time as well. And then finally, the returns in the equity pools. Our active equity pool is actually doing fairly well, down unfortunately down 20.5%, but that's not down as much as even the market was. And you can see what the historical number's been. If you go back over the entire life again, it's done pretty well, but like the balance pool, struggled a little bit for the last 10 years. The longleaf pool, which is a highly concentrated portfolio, that's the way those are built. it's not surprisingly very, very volatile. So it actually is down a good bit more even than the index. And that's what I would expect with the kind of portfolio that Longleaf is managing. It should go down faster and back up faster. So that's what we would expect to see. And then the two index pools, as you can see, are doing pretty much what they're supposed to do with again, pretty early returns. They're pretty closely tracking their relative indices, which is what they're supposed to do. So anyway, long term, we've been pretty proud of the returns, but for the last 6 or 8 or 10 years, we've really been struggling to make those pools what we really want them to be. And actually, that's also led to our introduction of the additional index pools, which will perform precisely like the market and at a substantially lower cost than the active management. I've always said that Memphis is a great place to put together an investment committee, and the investment committee, go ahead and flip the slide. This is our investment committee. We're really proud of the folks that we have on the committee. They have deep experience in the financial markets with specific experience and knowledge in the full range of products. So there are folks here that know stocks and bonds and real estate and private equity and alternative investments. They include seasoned money managers and professional and financial professionals and private investors as well. So everybody has a little bit different perspective, and that's what we're looking for in a committee like this, particularly in markets like this. Those are the people that make the tough decisions. So you're going to hear from Gerber Taylor in a second, but it's these folks that are the ones they're actually deciding how all of our money is invested. Now, they rely heavily on Gerber Taylor's expertise, but they're free to, and they often have deviated from that advice, and when they thought it was appropriate to do so. So with that, I think, Jay, what I'll do is just turn it over to get a little bit of the perspective of the chair of the investment committee.
Sure. Thank you, Bob. I'm happy to be here, happy to participate in this. It's certainly sort of a crazy time for everybody, but we appreciate you attending this meeting online. Hope it's all going well for everybody. I am relatively new to the investment committee, and I stepped into the role as chair, and so we can either give Bob credit for that or give him criticism for that in the long run. But it has been a good experience for me. I have 20 years of experience as a financial advisor and an investment manager running my own firm, Century Wealth Management. But more importantly, I have 20 years of experience as a donor with the Community Foundation. I think I opened my fund in late 2000, maybe early 2001. And overall, I've loved the experience. I love the services they provide. I love the flexibility of what it's like to be able to donate through the funds that we use. Just all the logistics makes it easy and flexible for donors, and I'm sure everybody on the call appreciates that. But I understand that from an investment perspective, it can be frustrating at times. There are times when the funds do well, there are times when they do poorly, and we are in a period now where it's been several years in a row where we have not lived up to expectations across the investment pools. And that is why the investment committee has been focusing on ways to improve the donor experience, improve the experience for our nonprofit partners, making sure that we provide the best overall results, which can be above and beyond just investment returns. And some of the things that we have done as a committee to improve those experiences are providing more variety and flexibility in the donor pools, which Bob just went through, but giving people the option to stay with active management, which hopefully will provide better returns in the long run versus going to an index choice, which takes the risk of those return profiles off the table and gets you exactly what you expect, which is the index returns. And then providing the range of options, everything from fixed income to balanced pools to equity only, or giving you the option to dial in the allocations that you want all of that is important, and I think it's good improvements that we've made from a committee perspective and from the community foundation perspective. A few other things that we have worked on, which I hope will improve the experience in the long run. We reviewed and revised our investment policy statement, and this is something that is not publicly shared, but it is something that we use to run the investment pools and also run the committee. And by taking a significant amount of time and attention to modify that investment policy statement, I think it gives us a more consistent structure of how to work as a committee and how to manage the pools going forward. And so while we may not see the results immediately, I think we will see good results in the long term. I know that internally, the staff, the Community Foundation, is also focused on the logistics of how the pools are managed, and that means that we've been getting reports out sooner than we have in the past, and I'm sure that's appreciated by all the donors. One thing that has changed, and you may have seen this in the slides that Bob just presented, is part of the changes in the investment policy statement has been modifications to the benchmarks that are associated with each individual investment pool. And the changes in the benchmarks are meant to clarify what the goal of the investment pool is and simplify the comparisons. And so I hope that provides some clarity for the donors going forward. One thing it's always helpful to know is that benchmarks are not truly investable. They don't have any fees associated with them. They are not real products. They are just measurements of markets. And so by the time you try and turn that into a product, whether it's an actively managed pool or whether it's an index pool, it is not exactly the benchmark. And that's why there's still some tracking error disparity between the performance that you're seeing across the board there. Within the pools themselves, we've focused on reviewing existing managers, making incremental changes over time. I think there's more changes to be made down the road. All of this is designed to improve the performance of the pools and ultimately improve the experience of the donors. So we're always open to comments and recommendations or ideas, whether that's so you can always reach out to me or Bob or Sutton or anybody else on the investment committee and share your thoughts. Have I covered everything you hoped I would?
Yep.
Okay.
Go ahead, Matt.
Matt, I think it's all you.
Okay. Can everybody hear me okay? Okay. Yes, it's been a difficult 10-year period for any diversified investment pool, which we are big believers in diversification, and we will try to let you kind of inside of what we think the research is suggesting for us. We have an internal research group that looks at a variety of different asset classes. Clearly, things have gotten a lot interesting in the last essentially 90 days. The world has turned. It's not something that anybody had a crystal ball on, certainly not Gerber Taylor. So we really try to sift through and understand kind of where we think we are from a valuation perspective, understand what values suggest for expected returns and risk, and what that can be applied to in a diversified investment program. So we'll kind of talk a little bit about kind of where we are and try to comment on, okay, why have we not done well as a 60-40, stock bond portfolio in the short term and in the last 10 years. And and we'll kind of comment on that. I would say that, when we've looked at our managers collectively over the long term with the investment committee, the managers in aggregate have done a pretty good job. It's been the asset allocation's been very difficult because the U.S. stock market has run away from essentially every diversifying asset class on the equity side And then it's been certain parts of the U.S. equity market have done exceptionally well, while other parts have not done as well. And that concentration and narrowness has been a headwind for globally diversified investors. So we're happy to answer any questions, and I know there's already some coming through, so we'll try to address those. Sutton, if you could help us address those maybe later. But if you look at on the page here, it's slide number 14. Just the first quarter of this year was pretty much nowhere to hide. If you look at as the result of the COVID-19 pandemic and the shutdown essentially of the global economy, equities across the world fell precipitously, particularly towards the end of February and into March. And you can see the U.S. stock market, as measured by the S&P 500, was essentially down 20% in 90 days. I'm sure most of you have seen that it was the quickest bear market in the history of the markets. And so it happened fast and furious, pretty much across the board. So equities were down in the U.S. anywhere from 15 to 30% in a 90-day period. The international markets sold off commensurately, even more so internationally. International stocks here are measured by the MSCI EAFE index, and emerging markets, which are more developing markets, were off 24% in a 90-day period. The bond market was pretty strong. That's measured by the Barclays U.S. Aggregate Index. It was up 3% in 90 days. But that kind of masks the relative struggle of parts of the bond market in the quarter. If you look at the U.S. corporate bond market itself, was off 4%. And high yield bonds, junk rated bonds, were off 13%. And the distressed end of the bond market, which we didn't put on here, was off something like 40% in the quarter. So the reason the aggregate did so well is about a third of that index is in U.S. Treasuries. So as the Federal Reserve's cutting interest rates, Treasuries are a big beneficiary of that. But as we got into a liquidity crunch and there's concern over corporate balance sheets, shutting down of economy, what that's going to do to earnings and cash flows of businesses, corporate bonds bore the brunt of that uncertainty. So the Federal Reserve and the U.S. government has thrown the kitchen sink at the pandemic and the quarantining and shutting down of the U.S. economy, and that's through 2 emergency interest rate cuts, which are now cutting, the Fed funds rate to 0. So as Bob was talking about, lower returns on the cash and equivalent pool. Expect even lower returns going forward because interest rates on the short end of the curve are now anchored to the 0 bound range. There has been a variety of bond purchase programs that the Federal Reserve and the Treasury has announced, and that really provided some cushion in what was a very difficult end of March until the Treasury stepped in and said, "Listen, we're going to buy bonds, we're going to buy exchange traded funds, we are going to basically backstop the markets." And then you've seen the $3 trillion stimulus programs, and another $3 trillion is being floated through Congress right now. So there's been a lot of money thrown at this to help us kind of get through this historic period of time. So where have all these difficult returns kind of led us from a valuation perspective? So one of the things that we really focus on is kind of where valuations are for a variety of different asset classes. And this is essentially showing you where valuations are for the U.S. equity market. That's illustrated by the blue line. The red solid line is kind of the long-term average valuation for the U.S. stock market. And then the red dotted line is looking at post the World War II period of time, kind of what the average valuation is for the stock market over a long period of time. So you can see at the end of March, equity valuations got a lot more attractive in our opinion. They went largely from about 26 times earnings to just over 21 times earnings, which is putting it closer to its kind of longer term average, but still, at a premium level to where it was from 1926 to date. So we really think of U.S. equity valuations when you measure it by the S&P 500 today to be a little bit above average, but not nearly to the extreme levels that we saw coming into 2020. If you look at the next page, this is just a way for us to look at, okay, if you're an investor in equities, Sutton, if you can flip the page, if you are buying equities today at these valuation levels, what has history said about the returns that you've been able to generate from these valuation levels over a 10-year period? So if you look where valuations were at the end of March, and if you look back historically over 10-year periods, buying stocks when they're trading at 20.9 times earnings have historically generated an 8.5% kind of return for investors. So we really hang our hat on this measure. When we came into the year, the valuations were in the 10th decile. The deciles, just to set you up on this chart, are running across the bottom horizontal axis. And this takes every quarterly measure period going back to 1926, and it puts it into different deciles. So if you're in the 10th decile, you're at the high end of the historical valuation range. And if you're in the first decile, you're in the cheaper end of their historical valuation range. So you can see we're kind of in the 8th decile. So we're not cheap. We're not at the extreme levels. And so historically, you've been able to generate a pretty nice rate of return. And I think what we've always kind of has struck us about this relationship of valuation and return has been, it's pretty apparent when looking at this that when you buy stocks when they're attractively priced, you have better returns. When you kind of look at first, second, third, fourth decile types of returns versus kind of where we have been for the better part of essentially 7 years, kind of in the 8th, 9th, or 10th decile. So valuations today are more compelling, and we do believe that commensurate returns looking forward are more compelling for long-term investors. If you look at the next slide that we've put together for the participants, and that is one of the things I think that gets masked by the S&P 500 is just, that's 500 stocks, but there are roughly 3,000 companies that make up the U.S. equity market. And so there's a lot more companies that are not in the S&P 500 that are at a manager's toolkit to be able to buy, and including mid-cap and small-cap stocks. And so we have allocations to small-cap equity managers in the equity and the balance pool. And it's been a very difficult period for small-cap stocks, essentially difficult period for anything outside the cap-weighted S&P 500. So this is measuring the relative valuation of small cap stocks and large cap stocks. And so in the last 5 years, if you've been invested in the small cap equity market, you've essentially lost money over that last 5-year period, which is a historical anomaly when you go back over the 40-year history of, say, the Russell 2000 index, which is a benchmark that's followed broadly for small cap stocks. And only 5% of the 5-year observations over that 40-year period have you had negative returns for small caps. And so I think that has been a significant headwind broadly for more actively oriented funds because active managers, a lot of them don't tend to camp out in the top stocks in the S&P 500. And that's been a significant headwind. And today, what the chart is showing you is measuring that relative valuation of small to large. And today, small cap stocks, because they have trailed so much relative to large cap stocks, are very attractively priced and relative to their larger cap peers at levels that we have not seen in 20 years. And We lived through the late 90s where the S&P was very competitive, where technology stocks essentially ran away from everything else. And small caps back then trailed tremendously. And valuations, as you look at the 2000 period, small caps were at a 40% discount to large. And so we're kind of here again today where small cap valuations are very cheaply priced relative to large cap. So coming out of the 2000 period, we think it's very important to realize that small cap stocks went on a 10-year run where the returns relative to large caps were significant. And so we are more positive on equities long-term because of better valuations, but we're specifically more positive on small cap stocks because that market has been tremendously washed out. So if we do get mean reversion here, we do believe the active management component of the balance pool are going to be more competitive with the cap-weighted S&P 500, which has essentially been almost impossible to beat in this last 10 years. Sutton, the next page is just looking at the international markets. And so the same relationship applies to the first chart that we looked at, just looking at where we are currently from a valuation perspective relative to history. And you can see this, the international markets have dramatically trailed the US market in the last 10 years. And you can see essentially since October of 2007, when it peaked at 29 times earnings, today those measures are at less than 14 times earnings and less than their long-term historical valuations. So as we think about where we are on the kind of the valuation spectrum for US equities, be it that they are in the 8th or 9th decile in terms of historical valuation, today international stocks are below their long-term average valuations and thus are what we find to be pretty attractively valued both on an absolute basis and on a relative basis. If you look at the next page, when you look at the relationship of the US equity market and the foreign equity market, the relationship of valuation is at an all-time extreme level. So you can go back to 1973 and look at the long-term returns of US stocks and international stocks tend to be pretty much in line with each other over a very long time. But since the end of the financial crisis, the US equity market has done materially better than the international market. And so US equity valuations have run at the expense of international equity valuations. And so what this chart is illustrating is that the valuation of the US equity market is 1.5 times more expensive than that afforded to you in the international markets. And if you go back to 1973, that's an all-time high reading for that relationship. And historically, the US stock market and international stock market has pretty much traded kind of in parity with one another from a valuation perspective. But this last 10 years has pushed that relationship up to an abnormally high level when you think about it relative to history. The bond market, we believe today is we think of bonds as a diversifier to equity, but also as a way to help control risk. But there are other risks in the bond market that we think about today, not just volatility of returns going up and down, but we think about it, particularly for the nonprofit partners that are on this call. Most of you have some sort of spending policy that you're trying to abide by. And with bonds today, the challenge is how do you get returns that would be commensurate with the spending that you might be required for the foreseeable future, particularly as the need for spending is accelerated because of the COVID-19 pandemic. So this chart on page 20 is just showing you kind of what's happened to the U.S. Treasury yield curve in the last 2 years. So as Bob was alluding to, 2 years ago, if you look at the middle part of the chart, that's the 10-year U.S. Treasury bond. 2 years ago, as we were sitting here, we were looking at 10-year Treasury yields at almost 2.75%, and they had really come off a pretty large bottom as the Federal Reserve began its interest rate normalization policy. And interest rates had gone up a lot in about a 24-month period. But in this last 24-month period, you can see Treasury yields across the board. The 10-year Treasury's gone from, call it 2.75%, where we were 2 years ago, to where we were 1 year ago, 12 months ago, at 2.5%. And as we sit here today, we're at 0.7% yields. So this is a profound effect on the expected returns off of fixed income broadly. And as you can see, when you kind of go from right to left, as you shorten up the maturity schedule, yields get even lower. So, we believe that bonds can help dampen the volatility of a portfolio, but they don't go a long way at generating absolute rates of returns for investors because of what the Federal Reserve has done to slash interest rates, and then the risk-off environment that we've been in the last really 4 months. So interest rates have plummeted in a very short order. And if you look at the next page, just kind of when you back away from the Treasury market and look at the corporate bond market, I'm just going to focus on the yields that are on the bottom right-hand side of the page. And you can see this is measuring the yields of different investment grade corporate bonds. At the bottom, you'll see AAA rated. That's the highest quality of investment grade corporate bonds at the end of March. Yields on corporate bonds on average were about 2%. So again, even if you go out into the corporate world and are willing to embrace a little credit risk, the absolute returns from fixed income are pretty paltry when you're buying 2% yields in the corporate world. And then you can see as you go down in credit quality, the yields get better. And we really saw yields start to pick up in the corporate world as liquidity started to dry up, and that we got into a credit crunch in late March, and you can see those yields spike up in the graph above that. And you can see the 12/31/2019. So in the quarter, you saw absolute yields in the corporate world really start to rise as people were concerned about corporate balance sheets and the ability of corporations to pay their debt holders. So we find that the corporate world is a little bit more attractive today. That's been one of the reasons why the fixed income active pool has not done as well as the index, because we don't have the same exposures as the index, because the index is so heavily influenced by the Treasury component of the fixed income market and our lower duration. So it's a combination of not owning as many treasuries and more corporates, and not having a duration profile that looks like the market when interest rates are falling, and not getting the full benefit of declining interest rates. But we do believe, kind of when we look across the fixed income market, there is embedded opportunity in these sorts of corporate bonds. And we do believe you've got very good corporate bond managers in your fixed income pool and in the fixed income side of the balance pool that we believe are going to recover, and we should earn the shortfall back as things settle down in the corporate world. So if you look at one of the things that we do follow on page 22 that sort of kind of covers that, is just the real risk in the corporate world today is because you've had a shutdown of the U.S. economy. The bond markets have grown tremendously in the last 10 years as corporations have used a lower interest rate environment essentially to borrow as much as they can, either to acquire new businesses. Share buybacks has been a huge trend in the corporate world in the last 10 years. But eventually, as the credit markets have grown, not every bond probably should be rated investment grade. So one of the things Gerber Taylor is really focusing on is, what happens to the default rates of some of these corporate bonds, and inevitably higher yields and corporate defaults sort of follow one another. And you saw that in 2001 and 2002, where yields went up and default rates went up, followed by a very strong period for corporate bonds and high yield bonds from 2002 through essentially the next economic recession, which hit obviously in the financial crisis in 07 and 08. And you saw yields and spreads and default rates pick up, and then the recovery ensuing. And we believe that, history tends to rhyme and reason with one another. And I think this is a chart that B of A Merrill Lynch did along with Marathon Asset Management, looking at expected default rates might climb to historic levels, and therefore are going to give a lot of credit managers opportunities to generate some pretty attractive returns, because you're going to have a lot of credits good credits will get thrown out with bad credits, and we'll be able to take advantage of mispricings in the credit market. So that's one of the things that we're really focused on. And I would say for the donors on the call, we don't have high yield in your bond portfolio. We don't take the credit risk there. But we might, if we thought it was really attractive, and do that at the margin. But we would want to see sort of default rates really peak before we wanted to step into that. But right now, your bond allocations are largely very high quality bonds that won't be subjected to this sort of a risk of defaults increasing. So, but it is one of the many measures that we look at when we look at the bond market.
I think if it's okay with you, we'd like to go to a couple of questions.
Sure.
The first question that came in is, it looks like Matt and Bart, this might be for you guys, but any panelist can jump in. Do you measure the upside/downside capture of your managed investment options? If so, could you comment on that performance measure? And if not, why not?
I'll start. Yes, we absolutely look at our upside and downside capture ratio. It's a part of one of the things when we're showing you returns, what we're not showing you is the risk level that we have assumed to get those rates of return. One of the things that's we've probably been put in the penalty box on is not only have we been diversified, but we have been intentionally more risk averse, and that's largely because active management has been a little bit more risk averse. So we haven't taken the same risk as the broad equity and bond markets. And so we do look at that. We look at the risk level and we look at upside downside capture. We did run this. It's not in the report, but if you go back historically over the long term and look at the balanced pool, the balanced pool has historically generated about 96% of the market's moves in the positive markets and only about 81% of its down moves over time. Now, that doesn't mean in every crisis period that you're only going to capture 81% of the downside. We certainly caught more of that in this last period, partly because we didn't have 40% in bonds to protect us in this latest period. And then it was just one part of the bond market that did well. So we do look at risk, we do look at upside downside, and the numbers are pretty compelling even on the U.S. On the equity pool. Historically, the equity pool has generated about 80% of the upside, about 68% of the downside of the market moves. So,
Matt, can you comment on how you look at underlying managers from that perspective as well?
Yeah. So we do look at underlying active managers, upside, downside capture ratios, and we do think about that a lot because we do know that one thing, if you're going to have active managers in your portfolio that are not going to invest like the broad markets, we would like for them to protect capital in down markets. And generally the way they're going to do that is when maybe they hold a little cash, and cash protects you. Certainly protected us in some of the pieces of the portfolio and the balanced and equity pools in the first quarter. And we also look at how they're allocated and share all of that with the investment committee. So yes, well, I think we definitely pay attention to it on the active management side, and it's one piece of what our research for managers is, along with a lot of other qualitative aspects to their portfolio, how they're invested, what their investment process is. So yes, we look at it both at the total fund level and at the underlying manager level.
Great. Thank you. I just want to remind everybody, in case they weren't on at the beginning, that if you have a question, to just submit it through the chat function, either at the bottom of your screen or in the More section. The next question is, what is the average duration of the fixed income active pool versus the fixed income index pool?
Bart, you want to take that? Do you have the number? You're on mute.
Yeah, let me pull that real quick. It'll just be 1 second.
Let me, while Bart's looking that up, I think one of the things that we've worked on with the committee, and it's been a headwind for us, is we've been very concerned about any normalization of interest rates over the long term. And so, as Bob mentioned, one of the ways to help protect bonds is, if you believe that you're going into a rising interest rate environment, you want to be high quality and you want to shorten up the maturities and the duration of that portfolio. And that worked incredibly well in the 2018 and 19 period, when interest rates were starting to normalize. And then that was a big headwind for us in this last period, where interest rates have basically plummeted. So that's been a headwind, but that could come back to us a lot if the economy continues to, if we get a recovery and interest rates do even pick up marginally, that shorter duration profile will certainly help us protect capital in the bond market.
The duration in the fixed income portion of the balance pool is about 1.6 years compared to the index at 6.2. And then and then looking at the fixed income pool, the duration there is about 3 years compared to, again, 6.2 for the aggregate.
Thanks, Bart.
One of the things I would say, just one last observation, is the interest rate sensitivity of fixed income gets worse as yields go down. There's less income and yield to protect you on any sort of change in interest rates. Now, if interest rates go to zero, your returns are going to be, good. But if interest rates go up by 1% and at lower yields, they're very sensitive to changes in interest rates, more so than they ever have been historically, because of the low interest rate environment. So I think that's one of the things that the committee and us discuss as we look at just the bond market broadly.
Great. Next question is, it seems that for 10 years you said international stocks are historically cheap versus domestic equities, yet every year they underperform, which has hurt performance and resulted in underperformance given the high international weighting in the balance pool. Why maintain such a large international allocation?
So yes, that's an absolute true observation. I think it's, one thing that we do believe, these things tend to cycle. In the previous 10 years coming into this last 10 years, as international stocks, I think, outperformed U.S. stocks for like 8 out of the previous 10 years and did much, much better than the U.S. equity market. So these things tend to be cyclical and mean reverting. And in the meantime, when we look at your underlying international managers and the valuations of those portfolios, the earnings multiples, the book values, and the yields that we are afforded there are very, very attractive. And we believe you don't have to get a lot of mean reversion in the relationship. If valuations just kind of stay where they are, the earnings and cash flows that we can generate from your international portfolios look much better than the U.S. Market. The part of the issue has been the U.S. dollar has been very strong, and we don't believe that the U.S. dollar continues to be as strong as it has been, like it has been the past 10 years. And, you know, if you were to panel your international equity managers, and even a lot of your U.S. equity managers, you look at the purchasing power parity of the U.S. dollar relative to foreign currencies, it looks incredibly overvalued relative to many of the foreign currencies. So based on valuation, based on these things tend to mean revert and are cyclical, we do believe that it makes sense to at least have what you have. And we're not, I think the international component and the U.S. component is about 40% of your total equity exposure, and about 60% of it is the U.S. So when you kind of compare global, you know, equities and look at the U.S. market and the international markets, we're pretty much in line with kind of how you would look at, you know, the difference between U.S. allocation and international allocation. If you look at the ACWI index, we kind of mirror that allocation. So I wouldn't necessarily say that we're overweight the international and emerging markets versus the broad market today. And the committee has upped their U.S. equity exposure, you know, within the equity allocation. That's been one of the things that has changed in the near term. So we're strongly suggesting that you stay put with international based on very good valuations of the underlying portfolios and the expected returns. We believe, because the valuations are going to be better, particularly if we get any sort of normalization between the two markets.
Can I just chime in with a comment there? So from what you want from the investment committee and what the investment committee wants from our consultant relationship with Gerber Taylor is good data that supports good decisions. And if we have that, we will make what we hope are the right decisions for the right reasons. Owning something that is relatively cheap versus relatively expensive, historically that has paid off. It doesn't do it quarter to quarter, year to year, but in the long term it tends to work. And those are some decisions we've made within the balance pool that have not delivered on the return expectations we hope for. Doesn't mean that it won't meet expectations going forward, but there is risk that it won't do that in the short term. That is one of the reasons why we wanted to offer donors more options about how they invested their money. If you don't want to take the risk of the decisions the investment committee is making, and you just want to make your own allocations, you now have those choices. So that is something that is available to donors that hasn't historically been there in the past.
Okay, we have one last question in the queue, and that is, I think, probably for Matt and Bart as well. What are the names of ETFs that invest in 5G stocks?
Boy, I would have to get back to you on that. I'm not sure what those ETFs would be that would be in 5G stocks. I know they probably exist, but honestly, I don't. It's not something Gerber Taylor tracks and follows, but we certainly can do the research and get back to the donor on potential options there. So,
great. Thanks, Matt. That's all the questions that we have in the queue, and we are bumping up against 5 o'clock. So, Bob, do you want to do a quick wrap up?
Yeah, just very quickly. We appreciate everybody's interest in the subject matter. It's obviously very trying times, and we're not through those trying times yet. I'm sure there will be some blood on the streets still to come. But we're taking this very seriously, as we always have. I think that the investment committee, and Jay could speak to this, the investment committee is challenging all of its assumptions that it's run on for the last several years. That's why we're seeing some significant changes to the pool, bigger changes and more important changes to the actively managed pools than we've made probably in the last 6 or 8 years. But in the meantime, as Jay said, we're offering more choices too. So please let us know whatever thoughts you have, and any other comments you care to forward to us. Again, thank you so much. Bear with us. Again, this is a time for patience and a long-term perspective. But we appreciate your attendance with us today.
Thanks, everyone.